Yo, what's up, dough chasers? My name is Jason White, and I'm the CEO and founder of Witness Riches, and we help people improve their finances, boost their credit scores, and fix their credit. Today, we're going to be talking about one of the most overlooked aspects when it comes to the home buying process, and that is, drumroll please, your debt-to-income ratio. A lot of people, when they're looking to buy a home, they will get their finances in order, they will get their credit score in order. But when it comes to getting approved for the mortgage, a lot of lenders want to make sure that you are not over leveraged, which means that you don't have too many debt obligations, because the higher your debt obligation, the more likely you are to default on your loans. So what we're going to talk about is your debt to income ratio, why it's so important, what is included in the makeup of your debt to income ratio, and what you can do to begin to minimize that as quickly as possible. So I want to thank you for joining me. Please, before we get going, please do me a favor, like this video, subscribe to the channel, and maybe invite a friend or two so that we can continue to share information that's going to help you and those you love. So let's talk about your debt to income ratio. I have some notes here, and what I want to do is I want to make sure I don't miss any information, because I want to make sure you leave this video with some value. So what is your debt to income ratio? Your debt to income ratio is basically a percentage of the amount of debt that you have versus the amount of income you're bringing into your home. So how they calculate that is they will look at all of your monthly obligations that are related to debt. So we're talking about a car note, a student loan, credit cards, and there are going to be some more that I'm going to name for you, but those are basically the normals. And they also look at including with the new mortgage that you're going to take out, and they compare that to the income. So let's say that you have a $500 car note, you have a $200 credit card bill, you have a $500 mortgage that you're looking to take out. Let's say, for just to make the math easy, you're at $1,200 of monthly obligation to paying back debt, okay? And your income that you bring home is $2,000. What they do is they have that $1,200 and they divide that into $2,000. That will give you a 60%, 55% debt to income ratio or percentage. Let me make sure I got that right before we go any further. Okay, 60%, all right? That will give you a 60% debt to income ratio. Typically, lenders, when it comes to getting a mortgage, they don't want your debt to income to exceed 45%, all right? So when you are looking to get approved for that mortgage, they want you to minimize your debt to income because they want to make sure that the likelihood of you defaulting on this loan is low. And in order for the risk to be lowered, you need to lower your monthly debt obligation. So they want you to pay some debt off, all right? And a lot of times people overlook this aspect of the home buying process, and they get denied because their debt to income is too high. And a lot of times people don't get advice from an individual like myself or from a realtor or a mortgage broker, and they go into the home buying process blindly and end up shooting themselves in the foot. So what do we want to do? We want to make sure that we understand what is included in the debt to income percentage, okay? And we also want to make sure that we're doing everything within our power to minimize our debt to income as much as possible, so when it comes to us buying our home, there is no problem, all right? Let's talk more about the kind of debts that are included in your debt to income. Some of the debts, for example, of course, your rent or your mortgage monthly payment, all right? That's included in your debt to income. Your homeowner's insurance premium, all right? So depending on if you already have this monthly obligation, or if you're looking to add this monthly obligation, they're going to look into adding that. Also, sometimes what's included is home association fees, okay? Homeowners association fees, because those are paid monthly. And because so, that's an obligation that they're going to look into adding to your debt to income. Also, auto loan payments, student loan payments, and a sleeper that a lot of people overlook is child support. Child support, though it may not be a debt, it is a monthly obligation that you're going to have to pay for up to 18 years, right? And lenders want to make sure that that is included and your evaluation of your debt to income, because that's going to hurt your ability to pay back your loans. And they want to see if that is going to hurt you as well. So they include that. Also, what's included are credit card payments and personal loan payments. All right. And what they do is with these debts, they don't look at the balances necessarily. They look at the minimum monthly payment in which you are required to pay back for these debts. And what you want to make sure is that those payments are small as possible, or get rid of them. All right. And we're going to talk about that shortly. But let's talk about what's not included in the debt to income ratio, so that when you are evaluating your own debt to income ratio, you're not including the wrong things. What's not included are utility bills, health insurance premiums, 401k investment accounts, transportation costs, saving accounts, or any other personal expenses like getting your hair cut, going to the movies, going to a football game, anything like that. Food, those are not included in your debt to income monthly obligation, because you're not obligated to pay those payments every month. You can cancel all of that, and it won't hurt your DTI. Okay. So when we are looking to, let's use our original example. Okay. Let's say that you are the individual who has a 60% debt to income ratio, and you want to get that under 40%. All right. Well, we had 3 obligations. One was for 500, another for 500, and one for 200. And what you want to do is, when you are evaluating your situation, you want to be able to get rid of the biggest obligation as quickly as possible. All right. And when you're doing this, you want to be realistic. Now, if you have a car note that you just acquired in the last 6 months, however, you have 5 years to pay on that car note, maybe that's not the debt that you want to aim towards if you don't have the ability to pay that off a lot sooner. Maybe if you have credit cards with low balances, however, the monthly minimum payments are high, maybe you want to target those. Okay. So let me give you an example of the debt that I would recommend that you pay off a lot more quicker than you would the other debts, so that you can minimize your debt to income a lot more quickly. Okay. Let's say that you have a car payment for $500, a student loan for $500, and credit cards that are equivalent to $200 a month. These are your minimum monthly payments. Okay. Again, your income is $2,000. So $1,200 divided by $2,000, that will give you a 60% DTI. All right. What you want to do is you want to aim at the debt that actually has the biggest monthly payment and will be easier for you to pay off a lot more quickly. All right. So student loans, you may be on a repayment plan for the next 20 to 30 years. If you owe a large amount of money towards your student loans, let's say 20, 30,000 plus, and your monthly obligation is $500, ask yourself, can I pay off $30,000 within the next 6 months to a year? Because typically that's the goal when it comes to buying your home. If the answer is no, that's not going to be your aim for paying off that debt a lot more quickly. Your aim is going to be something that's more realistic. So let's look at your car note. Let's say that you owe $5,000 on your car note. Your monthly obligation is $500 a month. Can you pay off your car note within the next 6 months to a year? If the answer is yes, then that will be the debt that I would suggest that you attack as quickly as possible, because eliminating that $500 monthly obligation from your DTI, that's going to reduce your debt monthly obligation from $1,200 down to $700. Let me see, 700 divided by 2,000. That would give you a DTI of 35%. Okay, that's good. All right. So if that's realistic for you, I would tell you to aim for paying off your car as quickly as possible. Let's say that you can't pay off your car as quickly as possible. Let's say, Jason, you know what? I can't afford to pay off my car $5,000 in the next 6 months to a year. Let's look at your credit cards. Okay. If you have low credit card balances, however, you have 4 different credit cards and each of them are $50 a month, then I would tell you to snowball those 4 credit cards, pay off those balances as quickly as possible. And when you pay them off, that eliminates the monthly obligation. All right. So that's basically how you want to look at your DTI. You want to look at it in a way as, can I pay off this large debt within the next 6 months to a year? And if you can, that should be your focus, because eliminating that large debt out of your life, and it has a large monthly obligation, that's going to significantly reduce your DTI and help improve your odds of getting approved for getting a mortgage. Okay. Now let's say that, you know what, Jason, I really don't make enough money to pay off any debts within the next 6 months to a year. What are your recommendations? Well, at this point, the only thing that you can do to help your DTI is to increase your income, because remember, it's a comparison of your debt and your income. So if you can't pay off your debt, maybe you can make some more money. All right. Now, I understand that it's not as easy as it seems. However, you may be a hustler. You may be somebody who can make some extra money. However, when you're looking to make extra money, for one, you have to make enough where it's going to reduce your debt to income under the requirements of the mortgage company that you're trying to get your mortgage through. So let's say it's 40%. So basically what we have to figure out is, how much more income do I need to bring so that my DTI is under 40%? So what we have to do is we have to compare our debt to our new desired income. And let's say that instead of you bringing home $2,000, you want to bring home an extra $1,000 a month. Okay. So we're going to do 1,200 divided by 3,000. That'll give you a DTI of 40%. So basically, in this example, in order for you to reduce your DTI without paying down debt, you need to increase your income $1,000 a month. Now, the thing is, if you're making side money, it has to be, a W-2 has to be provided, okay? Or there has to be a way for you to report that income so that the mortgage company takes you seriously. Now, if you're doing odd jobs and you're saying, hey, you know, I can make an extra $1,000 cutting grass on the side under the table, then that's not going to help your odds, because there's no way for them to prove that that is actually your income that you're bringing to the table and something that they can count towards your DTI. All right. And again, lenders want to see a consistency of at least 6 months for your income. All right. So I would definitely recommend that you find some way to increase your W-2 income, or, you know, find a part-time job so that you can increase your income. That would be my advice to you if you were one of my clients. All right. Basically, what you need to understand is that your DTI is important when it comes to you getting approved for a mortgage. All right. In addition to looking at your credit, looking at your income, looking at your assets and your ability to pay back the loan, they also want to make sure that you don't have too many obligations that are already outstanding. All right. And you want to make sure that you understand the debt to income percentage that the mortgage company wants, and you want to make sure that yours is under that percentage so that you can improve your odds of getting approved. So hopefully this information was helpful. If you are someone who is struggling to improve your credit and you would like help, I do own a credit repair company called the 700 Club Credit Repair under the Witness Riches umbrella. Please give us the opportunity to serve you. To learn more about our credit repair service, click the link associated to this video or visit the 700clubcreditrepair.com. If this information was helpful to you, or if you want to add anything to what I just shared, please comment below. I would definitely appreciate it. And if you're digging this hoodie, you can get your hands on your own at doughchaser.com. Check out my clothing brand. Feel free to support us. I would definitely appreciate it. At the end of the day, I just want to provide value to you that's going to help you transcend financially. Hopefully this information was helpful. Don't forget to like this video, subscribe to the channel, share this with your friend or family, and comment below to send me some love. Thank you for your time. I'm out. Peace.